everybody, and welcome to our DAT IQ weekly market update. This is our update for March 9th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by Ned Damon, who's our Principal Data Scientist, and Dean Croke, who's our Principal Industry Analyst. Welcome, guys.
Hey, Ken.
Good morning, Ken.
Morning, Ned.
It is spring has sprung. It's 60 degrees here in Ohio. I'm rocking the polo shirt. Gonna go grab a sandwich at lunch down the street. Love it. How about you guys?
I putting up birdhouses. You know, the Portland weather is not quite as nice as Cleveland, but we're getting there. We're getting there.
Same here, Ken. 60 degrees. Summer's not far away. Spring's definitely closer than I thought compared to where we were 2 weeks ago.
Looks like the old groundhog may have gotten it wrong this year. Knock on wood. So for those new to the program, we're here every Tuesday at 10 a.m. Eastern, talking about trends in the freight market, what we're seeing, things to maybe look out for, but most importantly, to answer your questions. So please feel free to drop questions in the chat section below, and we'll answer those towards the end of the program. And just a friendly reminder, these things tend to pile up towards the end. So if you want to get them in early, it gives us a better chance to get them over. We have a crew working in the back to get them over to us. Better chance that it'll get read and answered on the air. So in the interest of time, I am going to jump into key trends of the week that we're watching. So we saw volumes drop, but again, I don't think we want to play too much into that. We've had some really interesting, the activity on our network, it was just absolutely record-breaking over the past 2.5 weeks. So it's really no surprise. I mean, that sort of had to come down as things thawed out, both literally and figuratively. Just going to mute something right here. That just necessarily kind of had to come down. But we still have seen some pronounced strength in rates, which Dean's going to talk about in a minute. Another interesting tidbit, and also a bit somber, this marks roughly sometime this week, the 1-year anniversary of when we started to see COVID impacting the freight markets. Again, Dean's going to cover more of that, but just as an initial word of warning that we'll hammer home both today and over essentially the rest of the year-over-year comparisons are going to be very, very tough to rely on and fairly unrealistic for the balance of this year. So I would recommend, as you're thinking about making decisions, if your MO is typically to look at where we were the same time last year, remember what was happening last March, April, May, pretty much through the rest of the year. But most importantly, over these next 2.5 months, we saw that sort of whiplash up and down. So please keep that in mind. And then for anyone with small children, you'll know what I'm talking about here. Don't forget daylight savings time this weekend. It looks like it happens on Pi Day, which is also pretty cool. But again, Dean's going to point out an interesting thing about accident risk. So we want to make sure everyone's being safe out there on the road. So with that, I'll turn it over to Dean and have him walk us through the market update for this week. Dean?
Yeah, thanks, Ken. Let's get started with the load board activity. Ken touched on some of the higher volumes we saw. Load post volumes in dry van jumped about 21% last week. They're about triple where they were this time last year, so that's important. We're still prior to where demand crashed and spot market volumes started to surge. Last week's volumes, they're about the same as they were during the week of the polar vortex, which was almost 2 weeks ago. So there is some evidence the market is easing, but we're still a long way from being caught up. Truck posts increased by about 10% also. So the dry van load-to-truck ratio dropped down to 7.81 last week. Similar story in refrigerated. Load posts decreased 19%, still 3 times higher than this time last year. Truck posts were up slightly also. I suspect carriers taking advantage of higher spot market rates. The load-to-truck ratio dropped by 26% to 15.62. A little bit different in flatbed. Flatbed volumes climbed for the 3rd week in a row now. Volumes are up slightly, just 2%, about double where they were this time last year. The load-to-truck ratio dropped back to 74.57. So having a look at our dry van market condition index for this week, lots to look at. In the top 10 markets, again, represent about a quarter of our volume. Load posts dropped back 15%. That's after increasing 15% in the week prior, so returning is somewhat normal. The story of the week really, though, was lower volumes, higher rates. So rates moved up in the top 10 markets by about 12 cents a mile on average. So we'll quickly have a look at two markets, two parts of the country, and then sort of intersect in the Midwest. On the West Coast, volumes declined about 8% in Los Angeles and 16% in Ontario, but rates were up 16 cents a mile in both markets, so capacity was tighter. Same story in the Midwest, Chicago and Joliet, volumes dropped about 25%, rates were up about $3.19 a mile in both markets, up to $3.19 a mile. In Atlanta, capacity was pretty tight also. Rates increased 14 cents a mile, even though volumes dropped 15% week over week. Having a look at the refrigerated market, load post volumes in the top 10 markets decreased by 13% last week. Capacity was tight across the board. Rates dropped about 7 cents a mile in the top 10 markets. We'll have a look at the Pacific Northwest and then head down to Florida. This time, we typically see reefer volumes in February much higher in Seattle. It's consistent with Lent on the religious calendar, where there's a lot of demand for wild-caught Alaskan pollock during Lent. About a quarter of all fillet of fish sandwiches get sold in this particular period. So what you see is a lot more volume coming out of Seattle. Outbound rates out of Seattle were up 40 cents a mile to $2.90 to Denver, and Seattle to Chicago loads were up 30 cents a mile to about $2.24. In the southern part of the country, southern Florida part of the country, the Plant City Strawberry Festival is underway. It's about halfway through. What we typically see is the strawberry season sort of draws to a close, and then we start to see a lot more spring vegetables come out of that part of the market. So volumes are up in southern Florida. Rates jumped about 13 cents a mile out of there. Loads to Boston were paying $2.88, up 7 cents. New York were paying $3 a mile, up 12%. Capacity was probably the tightest out of Plant City to Atlanta. It's only 466 miles, but loads were up $1 a mile to about $2.98 a mile. So a lot of profit on that run for carriers. In the flatbed sector, load post volumes increased just 4%, not a lot of change. Rates only moved up about 2 cents a mile. The tightest part of the country in terms of capacity was the southern region around Memphis, Decatur, Birmingham, Jackson. In Memphis, volumes were up 5% last week. Outbound rates were up 15 cents a mile to just over $3. Next door in Decatur, volumes were up 9%. Rates were up 7 cents to $3.38. So capacity remains tight down there. Similar trend in Birmingham and Jackson. Volumes were up 4%. Rates were up over $3 a mile in those markets. So wrapping up with our dry van year-over-year spot market rate review, roads mostly clear, as Ken mentioned, temperatures rising, carrier networks sort of getting back to normal. One of the measures I look at is the interstate highway mileage from the passive road counter network. Mileage is back up 10% year over year last week after being down 3% year over year during the week of the polar vortex. So we're back about where we've been for most of the year, up about 10% on 2020 mileage. Capacity remains tight, though. Spot rates are up again for the third week in a row. Rates jumped another 9 cents a mile last week, ending at $2.44. Reefer sector reacted almost the same. Rates are up 9 cents a mile to $2.67, excluding fuel. Compared to the same week last year, rates are $1.82. Rates in reefers are up about 85 cents a mile higher. And wrapping up with flatbed, a little bit of change last week. Rates stayed around the $2.30, $2.32 mark, up just 1 cent. Compared to this time last year, rates are 42 cents a mile higher. And compared to 2018, which is always an interesting perspective, that was a pretty significant rate rally that started off this time in 2018, industrial economy-driven rate rally. Last week, rates are 60 cents a mile higher than where they were this time back in 2018. So that's it for the market update this week. If you want to find out more, go to dat.com/market update and download our weekly market update report. So that's it, Ned. Over to you for our forecast.
Hey, I am excited to talk about the forecast. Oh, now I'm finally live. I'm excited to talk about the forecast this week because they're doing things that I don't really expect. So we're going to start off with our dry van forecast. You can see in blue the market rate observed by DAT. And then off to the right, you can see our set of forecast models. You can see there's significant model divergence between our red line short-term model and our green line ratecast model. Ratecast is really expecting things to level out and maybe head down a tiny bit, but the short term, as the short term do, is kind of expecting things to keep going up and to the right. I'm a little surprised by that. And then in the middle, you can see our two blended forecasts. in gold and silver that are mixtures of the short-term and the ratecast model in different amounts and in different ways. Again, I really feel like the ratecast model, or even like a low end of ratecast model, is probably going to be more realistic going into the next couple of weeks. But the short-term model continues to surprise me. Moving forward to the reefer rates, again, we can see a similar chart with blue being the market rate observed by DAT, red being the short-term, which is pretty in line with the ratecast model, although the ratecast model in green is a little bit more pessimistic. And you can see kind of straddling the middle there, we've got the gold and silver blended forecasts. Here, there's a fair bit of model agreement, a lot of little bumpiness in the rate, but overall kind of a flat to maybe slightly up trajectory, although ratecast is a little bit more pessimistic about what's going on in the reefer space. Finally, on to flatbed. We have, once again, blue being the market rates observed by DAT, red being our short-term model that is being, in my opinion, a little bit too bullish. Although bullishness is somewhat called for by the ratecast model, still heading kind of up, although with a little bit more muted trajectory. But ratecast is expecting rates to start breaking downwards in the end of March. And then in the middle, again in gold and silver, we have our blended forecast, which are mixtures of those two models in different amounts and in different ways. That's about it for the forecast section. And I think we're ready for our DAT IQ question of the week. What do you think, Ben?
I'm ready if you're ready, Ned.
All right, let me go dig up the exact wording so that nobody gets cross. After a year of COVID-19, what's your biggest takeaway to date?
I can start. So I think it was a splendid year to launch a predictive rating product.
Oh, God. I feel
like DAT should subsidize your milk of magnesia or Pepto-Bismol budget over the last year. But in all seriousness, the analogy I used is that it's like never playing baseball before, and your first time picking up a glove or a bat would be the Game 7 of the World Series. Luckily, it's been a very rewarding year in that sense because we've been able to genuinely help a lot of folks navigate, through the lens of both short-term and kind of once we were in the thick of it, longer-term forecasting. But all in all, I'm really happy we did it because we just mentioned at the beginning of the show that the year-over-year comps are going to be really tricky this year. And if your standard process had you just pull in 12 or 13 months of history, looking at ratecast, which is going to be more informed on what, Ned, 5 to 6 years of history at this point.
Yep.
So that's not, that's going to at least smooth out the bumps, if you will, of 20 and give you a better look forward of what might be projected. We saw that in a lot of the, I called out on LinkedIn a few weeks ago for sample RFPs, and we've had extremely positive feedback on those. A lot of secured business, and we continue to see ratecast remain fairly accurate long-term and frankly, surprisingly wicked accurate in the short term. 14 days out, we're still at 95% accuracy. There's only a few times during COVID, I think April and May of last year being the only real time where we dipped below that 95% gold standard. So, and even then we were, I think, at like 91 or 92. Correct me if I'm wrong, but I think that's about where we were.
That was the last time I checked, but that was also a couple of weeks ago. So
yeah,
I do want to defend the honor of ratecast, though. You said it was like never having picked up a bat before, and then you go into the World Series. We had taken very many practice swings. I had been practice swinging for about a year of like blind ratecast. Blind is the wrong term here, but like internal ratecast forecasting before we launched it as a product. So.
But to keep up this analogy and kind of beat it into the ground, you were in the batting cages. Then you stepped up the plate, and Clayton Kershaw was standing up at the mound, and you had 50,000 people in the stands.
And I would say that we hit a solid single.
No, I honestly, like I said, bracing for the worst. I can't say enough positive things, and it's kudos to you and the team, Ned, about how well it performed. Now, look. In full disclosure, if you pull our 12-month forecast for, February 15th, 2020, it's probably not looking too hot.
No.
But again, most folks are managing their books of business I'd say most brokers are probably managing their books of business 0 to 15 days out at the most. And using the long-term forecast for RFPs. which we all know that most RFPs were pushed anyway last year into the tail half of the year, which is where things sort of regressed back to the mean.
Yeah, no, I mean, we build a mean model here in the data sciences squad at DAT, and I'll be excited when more things get released. Hopefully not too far.
What do you think, Dean? Moving away from Raycast, what is a year into this thing from a freight perspective? What do you think?
Yeah, I'm still shocked by how much additional volume's been added to the freight market in a particular sector, like in that retail, fast-moving consumer packaged goods. I'm still amazed at how much stuff we've purchased over the last year. I still question how long that will continue, because as we've always sort of questioned, how much more of these one-off items can we buy as we sort of all adjust to living and working from home. But the other thing that struck me was how fragile the freight networks are and the supply chains are, because it didn't take, we kind of moved rapidly from just in time to just in case. And we saw a lot of people get caught out last year with short inventories and then played catch up all year round. They're still playing catch up. Jason Miller did a great analysis last week, and he looked at retail inventories, which are short about 40 billion compared to pre-pandemic levels. So when you look at about $3,500 per ton in that space for mixed freight, there's something like 660,000 additional loads that are required just for inventories to catch up again, and that assumes demand is flat. So it's what really shocked me, I think, was how much more freight there was in a particular sector and how little there was in other sectors. Yet capacity remains tight. Drivers are hard to find again, and we're seeing record levels. So to me, I've seen more change in the last year than I think in 20 years of studying the freight market here. That's sort of my big takeaway.
Yeah. For me, it's kind of the flip side to Dean's, where the freight markets are really fragile, but there's also a lot of resilience. If you had told me March of last year that you're going to be in lockdown for a year, I don't know what I would have done. But, the fact that people have been able, especially people in the really kind of key industries, have been able to keep things running under these extremely unusual conditions, and folks have found ways to adjust. I think it really speaks to how, not resilient necessarily, but how kind of dedicated to the craft a lot of folks are. Like, conditions have not been easy, COVID aside, even with the polar vortex and everything else going on, but supply chains are going through. I can buy toilet paper in the grocery store again,
But the big shift that I've seen is sort of, these depleted inventories drove a lot more demand for our overseas trading partners to produce a lot more goods, particularly around PPE. So what I visualize in my mind is we've gone from having thousands of different supply chains funneling goods into where we would normally buy things through bricks and mortar, to far fewer channels coming in through ports. And what you're seeing now is that, and this is part of the reason truckload volumes have been so high, because of the tight capacity on the oceans, shortage of containers back in Asia. A lot of that freight that's hitting our ports all across the country is there's less of it moving through sort of intermodal networks, and more of it's being just unloaded and transloaded into 53-foot dry vans. So there's more volume because of the need to just reposition containers back in Asia as quick as they can, and that's been another big benefiting concept that truckload carriers have had to look at this year, because they've seen volume in ports that they wouldn't normally see.
Yeah, I mean, it's I grow ever the more concerned that we have like all this pent up uncertainty that's due to unleash, which is, I think, my biggest concern. Right, is that we've been essentially putting coins in the bank of uncertainty as every month has rolled by. Right, that we've sort of, nothing's really been resolved. Right, we haven't seen what happens when the industrial economy comes back to relatively full force. We haven't seen what happens once people start eating out and traveling about. We haven't seen what happens when inventories normalize, whenever 2x4s aren't $6 a piece anymore, et cetera, et cetera, et cetera. So I think when you have to sort out a few things at a time, I think the things can handle that. But I think once you have to sort out all of that sort of all at once, that's when I grow concerned. I'm not being pessimistic. I'm thankful that things haven't jumped off the rails, but I just grow concerned that, like I said, it's going to kind of be all of a sudden and all at once when things start to ease. But with that, let's move to Q&A. Again, we already have a bunch of questions, but that doesn't mean we're not going to get to a bunch more. So please drop your questions in. Nothing too controversial that won't get answered on here. We'll take anything head on. Right, Dan? Right, Ned and Dean?
Need. Yeah, no, I mean, I'm a little more circumspect. I think you're the most aggressive person out of a lot of us about answering questions, but none of these has seemed too spicy. Lamb asks, what are your thoughts on 2022, or at least Q1 2022? I feel like your coins in the bank is there. We don't know whether they're all going to come tumbling out of the pinata at once, or...
Well, I got a text while we were on the show from someone who's watching, who's also... who I've worked with in the past, and they're in the process of they're doing their strategic outlook, and they're asking, should we focus on volume or profit? And the hope would be that 2020, in retrospect, was a year of tremendous volume at smaller, especially if you're leveraged on the contract side, smaller profit percentages. I would say the wheel should turn a bit. We should see the other end of this freight cycle certainly by Q1 2022, unless someone here disagrees. So I think this is going to maybe be a year of getting your yield up, right? Taking advantage of those higher rates, optimizing the volume that you secured in 2020, and then preparing for 22 to be the year where you're potentially by the tail end of 22 going back into volume mode again. But what do you think, Ned and Dean?
I mean, I think that it's going to really depend on your... I mean, 2022 is really far out, but I guess my expectation is at some point things are going to turn back towards more rates being a little bit more reasonable, more standard, and I think there's an opportunity for you definitely to catch some windfall profits in that neck of the woods if you're a broker. I don't know. Your take, Dean?
Yeah, it's almost too far out to, I don't want to get too far out of my skis here, but if you think about when we start to get back into what feels like more normalcy in just our normal daily lives towards the end of the year, I would expect Q1 of 2022 to be more like, a 2019 year. Now, the caveat there is that we don't get the virus under control and we have more regulatory, impediments to, restaurants opening up and travel and things like that. So if everything falls into place, then I think we should see a more normal Q1 next year versus Q1, this year and last year.
Juan asks, I want to know what pays better, dry van or flatbed?
So that's a really great question. I'm going to plug. We have in the can a really great long form interview with some folks from Miller Transfer. They're a large specialized flatbed hauler, and they had some really excellent points around this. So the short answer is flatbed for sure. It's more work, and it requires more experience. But we're going to have essentially. I would highly recommend making a mental note that we're going to have that. We'll be plugging it as we get closer to releasing it. But they talk a lot about how, once you get into the specialized stuff, they're paying for hotel rooms so you don't have to stay in your truck. But they also talk about some of the enhanced requirements that come along. You're not going to be sort of right out of CDL school and hauling permitted loads for power transformers and all that stuff. That's coming out March 31st. Our producer chimed in, so I just wanted to shout out that. We also, while we're on the subject, then I'll turn it over to Dean with probably a lot more insightful answer to the question. But it's next Wednesday. We have our interview with David Spencer at Arrive Logistics talking about pricing and forecasting and all things business intelligence. So that was a really great sit-down conversation. I'm looking forward to that getting released. Anything to add on the flatbeds?
Yeah, I would have normally said no. Other than the fact that flatbed rates are pretty good at the moment, if you have a drop deck trailer, in the flatbed space. Yes, you can run more dollars per mile. You don't need to do as many of them as in miles. But traditional flatbed, you're going to spend a lot of time under cranes, a lot of one-off project work. You're going to run a lot of empty miles. It's a lot more physically intensive work. So you've got to weigh up the type of freight you're hauling, and then all the downtime that you're going to have to factor in because of the nature of the freight. So when you look at the rates might be one thing, but you've got to look at the total amount of productivity you can fit into a week, especially with ELDs sort of crimping your flexibility when it comes to loading and unloading.
Yeah, that's a great point, Dean, because a lot of times that's overlooked. I can remember thinking back to my days being in the industry that people just need to be honest with themselves about what kind of driver they want to be, especially if you're an owner operator or a small business owner. Like the thought of running very low empty miles and super high trailer utilization is awesome, but you have to be willing to be out on the road a lot and essentially have no downtime between shipments. Right? There's definitely a better lifestyle fit, especially if you're in the physical condition for it with flatbed. If you appreciate the downtime. Right.
Yeah, you need. We used to pay our drivers goat money because of all the climbing up and over loads. Because it's probably one of the most physically demanding jobs you could ever do, especially during winter. That's you don't always get compensated for just how hard the miles are.
Right. I'll handle this one before Ned moves on to the next because it's less of a question. But Joseph asked about model accuracy. So we have what they've deemed internally the corn on the cob chart, which is exactly what you talked about. It's actual versus predicted. We can display that next week. We'll make a note to pull that on. We'll have all of February through the first 14 days-ish next week. So we can pull, that's a lot better because measuring national forecast accuracy is not really, we don't even market that. It's honestly sandbagging because our national forecast accuracy is something like, we just measured, it's like 98.5%. But again, it's
not recently, but yeah, in general.
Yeah, but again, it's not as meaningful as we actually measure every single prediction against every single actual. And usually that's about 200,000 projections for the first 14, if you look at just 14 days out per day, lane to lane. So we can get the corner of the cob chart for next week for sure.
Lamb asks, will rates pass along to the cost of living, such as groceries?
So this is an interesting question. I'm not sure that it answers Lamb's question, but it's something Dean and I were talking about extensively yesterday. And it's, to what extent is the CPI basket failing to capture actual inflation that's occurring right now? That's kind of a heavy question for a weekly freight podcast, but it's got some implications. Right, the CPI basket, if you're not familiar, it's essentially the generic measure of inflation, or the official measure, I guess, of inflation. And it tracks a basket of goods over time to determine how those prices have been, I guess, inflating or deflating, but it's predominantly inflating. But I think it comes down to how does that capture a 2x4 or mulch or a desk chair? There's some things that we've seen rocket high numbers of inflation. And I think the other thing is how does it contemplate trucking or some of these kind of service economy type? And it doesn't, right? That's the short answer. But I don't know to the extent that what we're seeing in some of this rates isn't this sort of systemic inflation across the trucking industry. It's something we need to pull out and think about in the numbers. What do you think, though, Dean?
I've seen some inflationary pressure depending on the type of supermarket and their size, their footprint, the limits they've had on the number of people in a store. So I've seen some of that. I've also seen some price rises for things like beef, seafood. Across the board, manufacturers have struggled with the physical distancing requirement, absenteeism, over the last year. So I've seen some items become pretty expensive. In this week's market update, we're talking about cabbage, St. Patrick's Day's next week. So I can only expect with about 45% of the cabbage volume coming out of McAllen in the Rio Grande Valley that we're going to see some inflationary pressures on that as a result of the polar vortex. So I think it's I think the answer to Lamb's question, I think the answer is yes, we've seen some inflationary pressure, but I don't know that it's anywhere near some of the other items that aren't in that basket that Ken refers to.
Yeah.
So transportation services is in that basket, right? So I think what I meant by we're going to have to tease it out is I want to dig more into those numbers and maybe even phone a few experts around, like actual economists, and talk through how what we're seeing in the CPI as it pertains to trucking and transportation services directly relates back to U.S. full truckload over the road that we talk about on this show every week.
All right, we've entered the lightning round according to our producer. So quick, fast. Joseph asks, what are the data? What data is used for RateCast? That is the RateView submissions data. So it's not posted rates, it's paid rates. I know that got answered in the feed, but I feel like it's important to stress that we use paid submission data, meaning submissions that have been paid, rather than posted rates, because posted rates are always going to skew to the high side of the old price chart. Gary asks, and we maybe not have a good answer to this one, what are power only rates? Is there like an easy peasy rule of thumb that we can use to adjust for those, and just like percent of what the going spot rate is?
We've been answering this question a lot lately. I'm reading an email, so I apologize for not looking at the camera. So if you're using the shipper or you're not responsible for furnishing the trailer pool, general rule of thumb currently out there is 25 to 35 cents a mile off the cost of your standard rate that we're quoting on this show, or kind of in RateView or whatever. If you're being asked to furnish a trailer pool, or even if you're just running a couple trailers, the increased empty miles may not make it any more cost advantageous to run power only. So that's something just to keep in mind as you think about it. And most folks do account for the cost of their trailer pool separately and then build it into the rates as sort of a peanut butter spread. It takes quite a large amount of those trailers to really get into single unit utilization type calculations.
JC asks, is now a good time to become an owner operator in flatbed? Dean?
Yeah, for sure. I think, but I'd be banking every bit of profit I could, because I don't know that rates stay up, this high once things return to normal. So my advice would be yes, but make sure you understand your operating costs and put away money for that rainy day. That's inevitable.
Franklin asks, best lanes to get into for dry van and flatbed. There we go. Where are you?
LA to Dallas to, I don't know. Anything that gets you to Southern California and back as loaded as possible and often is probably your best bet for dry van, without question. I think it's good advice in general to stay around the ports. Wouldn't you say, Dean? I mean, there's pretty much, without exclusion, staying around the ports and then getting back loaded, even if you have to tri-haul or quad-haul back, is probably your best bet.
Yep, I'd agree. Yeah, absolutely.
Finally, Gary asks, did you cover diesel stripping out all profits because the surcharge is not going to catch up to the rising rate of diesel? No,
we've covered that considerably over the past few weeks, right?
Yeah, not this week.
It's going to put a cramp on total profits for sure. And it's an odd relationship, at least in my previous life. We would study that increased diesel prices actually had a small but still observable deflationary pressure on total rates, because you're passing along a lot of those costs to the shipper, and it's kind of creating the illusion of higher cost, even though it's being driven by a fixed schedule. So you may actually get a little bit of a double whammy there. But look, as long as fuels stay high, unless Dean has a different perspective, it's going to be a thumbs down, or at least a downward pressure on total profits and operating ratios.
Yep, I'd agree.
And that's the end of the questions.
All right. So if you guys have any more questions that didn't make it in here, you can always hit up askiq@dat.com. We have that basically routes to all of our inboxes, and we answer those as quickly as we can. Check out Chris Kaplis' Freight Find podcast. I know there's some really interesting stuff going on that side of the fence. And that's really about all I have this week. We will see you next Tuesday at 10 a.m. Eastern, and we hope you all have a great rest of your week. Thanks.
Thank you.
Bye, all.
Bye.